Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, September 25th. I'm David Zarling. I'm here with Ian Vanilla Price McMillan. The S&P 500 closed at 3298. Plenty of price action this week. Ian, lots of things to cover. Where should we start?
A lot of price action this week. Some fake outs to the upside, some fake outs to the downside. Did not get back up above 3,300 to close the week, but we did hold 3220-ish. Was the June highs.
Right, June high with the S&P 500.
Mm-hmm.
I know that we talked about the Russell 2000 that was in a situation where it was trying to hold its June high. It didn't. I believe that started last week. It's still below its June high, whereas the Qs are above its June high, and like you said, the S&P 500 above its June high.
NASDAQ holds 11,000, but again, as you said, Russell's still in doing its own thing in no man's land. Obviously, banks continue to be a pretty huge headwind there.
Right. I mean, we still have the Russell just above 145, and that's a level that goes back 3 years. I mean, you could make the argument that Russell 2000 is a buck higher than it was 3 years ago. It's basically gone nowhere. And
big old opportunity cost.
Yeah, big old opportunity cost.
Or diversified portfolios out there.
Mm-hmm. So, right, we continue to see weakness out of banks. We continue to see just tremendous weakness out of energy to the point where the price moves there. We've said on here plenty of times that price leads the narrative, or price first, news second. And so some of these things, whether we're talking about Chevron or ConocoPhillips or even, a big one like ExxonMobil, this is getting into territory where you wonder if stories start coming out. But that's to be determined.
Absolutely.
That's to be determined. So we'll see. We have on our hands from a weekly perspective, we've got some weekly candles on our hands. Last week we talked about, you mentioned the NASDAQ 11,000. We're above there. We talked about Russell 2000, 1450. We're above there. S&P 500 still working on that 3,300 level, 3,330 level, and still below 3,400, which we've talked about plenty of times. So it'll be interesting what the weeks ahead bring, but it is notable what we're seeing out of something like the NASDAQ. You want to touch base on that a little bit?
I think it is notable, and given what we saw this week and looking back at the March lows, and in particularly March 18th and March 23rd. So as we know, the NASDAQ bottomed on March 18th. I guess you could call it a double bottom, and for all intents and purposes, revisited those lows on the 23rd, while on the 23rd, all other major indices made lower lows. And so led out of, right, that was a clue we know now looking back on, led out of the bottom off those lows. And something, again, we saw this week on obviously a shorter term basis, but NASDAQ bottoms on the 21st, which was Monday, right after the gap down, and then does not make a lower low on Thursday, actually makes a higher low, while the other indices like the Russell 2000 and the S&P 500 did make a lower low yesterday morning at the open.
Right. And so we
have
kind
of a divergent bottom there in regards to relative strength, I would call it.
Right. Yeah. If you've got a lower low in the S&P 500 and Russell, but yet you've got a higher low in the NASDAQ 100, that's something you could look back on and say, wow, that made a lot of sense looking back on this being a potential bottom of this corrective period that started at the beginning of September, that this would be where NASDAQ reasserts its leadership, which would fit the characteristic overall, like you said, basically since the bottom in March. That if we're reasserting large cap growth, large cap tech as leadership going forward, that's an ongoing continuation of a trend, which would make sense.
I think we're starting to once again see that. Katie Stockton, a great CMT, had a great chart again today of looking at growth versus value, both of the large cap and small cap. And I mean, it seems to me that we might be churning back up. It's very similar price action to mid-June.
Right.
So May through mid-June, I'd say mid-May through mid-June, there's a 4-week period. Growth got hit pretty hard relative to value. And about June 9th, we bottomed there. So it's looking like potentially, right? And that would keep with the trend.
Right. And yeah, and the chart
growth continues to lead.
The chart she shared, it's, she's using a common 50-day moving average. Prior 50 days of information is rising, right? Going from lower left to upper right, 50-day moving average. That is one definition of a trend. And at that level, it appears like there could be accumulation happening, growth versus value on a relative basis.
And you've got things like Apple holding above 108, 106-ish, looking to carve out lots of things. I have to say I was pleased with how indices closed the week. And obviously, again, I think the one index that's out in front, that's kind of more not in blue skies, we're not at all-time highs, but the one that has more open space to run in regards of, we're talking about looking at behavior to the left, I think is the NASDAQ.
Right. Well, and just look at the different scenarios. Okay, so let's just walk through this. We've got a Russell 2000 below its June highs. It's touching or just had some resolution off of the prior 200-day moving average, prior 200 days of information averaged, a downward sloping 200 days. It's below its 50-day. And you have the same below the 50-day for S&P 500 and NASDAQ. But you've got a flat 200-day on the S&P 500, but a rising 200-day on the NASDAQ, right? So that's indication of a stronger trend.
If and it's been strong. I mean, there is no denying the strength we've seen in 2020 out of the NASDAQ and tech and growth.
So we could still see rotation, but I know we also noticed that, there's still some in industrial.
Industrials, yes. Transports remain strong. Trucking, things like that. In regards to the growth versus value in general, two big things that I keep coming back to. Pointed them out on Twitter is, again, banks and energy. So you've got, let's take a big bank like Citigroup that is now at a lower relative low to the broad market than we were at the depths of the great financial crisis.
Yeah, they hate it more.
They hate it more than they win the most. I would assume, now again, I haven't been alive since the Dow has been open, but I assume probably one of the most hated environments for financial stocks. And you're telling me that now we're below there. And then going back to energy, again, making XLE, making new relative lows this week, giving back up everything that they had gained off the March lows from an alpha sense. Just brutal.
Yeah, between Citibank and Exxon, I don't know which ones. I mean, that's just those two canaries for those sectors. It's going to be very interesting to see where accumulation happens for those, but it's not happening yet.
And you saw the FANGs had a great. The FANGs are leading us out of this. Things like online retail, fintech, the ARC.
Exactly.
You've got Kathy and her stocks that continue to hold up extremely well.
Yeah, if you were to look across a lot of those things, everything you just highlighted there, when you look at the corrective period since the beginning of September, there's no doubt about it that, online, fintech,
semiconductors continue to hold up well.
Holding up well.
Esports. I mean, these are all growth, discretionary. It's strong out there. Overseas, still not a lot. I mean, I'd say the same. If you're a portfolio manager and you've got a mandate of some type of foreign exposure,
sorry, man.
Sorry.
Yeah,
I guess Finland, Denmark, Chinese consumer has been strong. Clients are familiar with a lot of these areas we're mentioning. So we can see where to go. We were quite bullish on materials and industrials. Those pulled back a little bit this week.
Well, let's pivot over that way a little bit, because we don't, whether we want to talk about materials. Another interesting development this week involves precious metals.
Yes.
Which got
gold
hit
below 1900.
Yeah. We've been talking about gold holding 1900 and seeing those get hit pretty hard. That's information.
Miners got hit real hard this week as the dollar, right? So I'm looking at something like the dollar index Dixie, a great short-term breakout this week from a little base. Now, I'd say intermediate term, still in a downtrend. Long term, still in an uptrend.
You talking dollar?
I am.
Yeah.
Now, you can argue, so let's say that, and I think most technicians would agree, dollar's been in an uptrend since 2011.
Mm-hmm.
And probably until we're below 80, and this is tough, but probably not until we get below something like 88 can you consider it now entering a downtrend. And I know that's kind of a far way to go, but we've got to make a lower low.
You got to have a lower low.
You got to have a lower low.
I mean, you can argue that it's a change in rate of trend only because we broke that rate of trend recently if we're connecting the lows that go back to June 2011. But your point is made. You have to have a lower low for the rate of trend to change to down, to a downtrend in the dollar.
Well,
so it could be a sloppy
I think
mess.
Gold is below 1900, and that's a big fun round number to use. And, it's a logical number to use. Now things would get super sketchy for gold. I'd say if we're below 1800.
Yeah.
I understand being below 1900, 1920, but a deeper retest would make sense. It doesn't scare me off as much. Still a very strong uptrend. Did not break in the way a lot of people expected.
Right. And
I think we had this huge run up
and a consolidation.
How many since late July we've been moving sideways essentially.
Right. And for non-technicians out there, when you have an uptrend on your hands and then price consolidates, moves sideways or compresses, what you want to see is confirmation of the trend. And the way that's confirmed is by moving in the direction of the primary trend out of that consolidation. And that is not what happened.
Broke lower.
Yeah, that is not what happened in gold.
Lower, which was surprising. But again, these are, right, we're not looking at technical analysis as a definite.
Yeah, it's not a predictor. It's just
simply gives us what we would typically expect behavior to look like coming out of a consolidation.
Studying price allows you to develop thesis, and the thesis in this case would have been if we're going to see silver move higher, it's going to move higher out of this compression. It didn't, and that's tremendous information.
And coming out of, so we had the big rally off the lows, March and April. We consolidate for essentially all of April and May. June, July, we rip higher up into early August, can start consolidating again. So I'd still argue an uptrend.
Yeah, I mean, it could be, but it's damaged goods for now in the near term.
And it's information that we couldn't keep going.
Right. Exactly. And so we can use those price levels to manage risk, be involved and not be involved when we break down to those type of consolidations. So big downward week for, something like silver, something like gold. I guess you could make the argument that copper kind of sold off a little bit, but not as much damage as in the precious metal space.
No.
But we talked about banking stocks, energy stocks. We talked about the similarities between the March lows and potentially what we're seeing now. On the flip side, we do have price below some 50-day moving averages in some major indexes, but there's definitely areas that are holding up well during this scenario. And we're not seeing like credit spreads blow out.
We're not seeing credit spreads blow out, which is something you've really been on top of lately, and it's a good sign. Which, especially with energy stocks continuing to deteriorate as they have. I mean, even with the breath skins that we run, I mean, it's continuously during this, right? We've had a big pop in new lows versus new highs, and those have been led by banks, by exploration and production stocks, oil stocks. So I would say overall, big picture, we're still below 3,300. We're still below 3,400, going back, or 3,330 and 3,400, going back to really 2 weeks ago on the 11th, where we were pretty clear that below 3,400, things could get a little weird. And I don't know if they're done.
Well, the first step would be, that 3330 level, getting above there and sustaining it. That would be step one. And like you said, I would even say the 3420 level based on interaction of supply and demand during this correction. 3,400 would be great. 3420 would be even better.
3420 you would need 3420 to clinch it,
right,
and prove that, right? Because we've got some upper shadows there. How many times did we test 3420 on the way down? 4 times. So again, no type of selling pressure like we saw in February, but
yeah, that's for sure.
And what we need to see leading is what we mentioned earlier. I'd add software to that list. I'd add internet to that list.
Well, and it's good to see the things that you talked about before. And in something like internet with basically a bullish engulfing week over the prior week. And so there's definitely some things starting to show accumulation.
Well, let me ask you about something that has shown a lot of indecision lately, and I think the fact that it finished perfectly flat today, 0.00%.
What do you got?
Long-term U.S. Treasuries.
Yes, long-term U.S. Treasuries. Well, they had been compressing for so long. If I look at something like
sometimes I wonder if they'll compress so much they'll just evaporate into thin air.
They're gone. No more Treasuries. It's going to be interesting, if I look at something like a T-bond futures, if we can retake something like the 178 level, that would be a pretty important development. But if you're going to have bonds break higher, the Treasuries break higher, I don't know. I mean, banks look bad now.
I was about to say, it says to me that market participants, via their unwillingness to buy financial services stocks, do not think that rates are going higher.
Yeah, I mean, if we're moving higher from here in Treasuries and we're watching rates drop and again,
I mean, something TLT's flat since March 10th.
Yeah.
So a great hedge, right, on the first 2 weeks of the down, or excuse me, March 9th. Now, March 9th was when, no matter what that was when it really hit the fan and everything with a ticker got sold.
Right.
So, and we haven't gone anywhere, I think, above 162 probably. I mean, that's a huge level on TLT.
Yeah, and something like TLT, and even like 172 on something like that, we haven't crossed back above there. But yeah, I mean, 165, kind of where we're at right now, we've moved sideways since off the bottom. Now it hasn't been close your eyes and open them back up and it's flat.
And something we go back to, if we are allowed to step outside of our technical analysis box, is that, and I've talked to a lot of other technicians that have the same viewpoint when in regards to fixed income, is that, Jerome Powell has told you for 5-6 months now that they have no interest in attempting to raise interest rates or putting any pressure behind that. Now, we can talk about inflation targets and blah, 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 which they haven't met for who knows how long. But they have the Federal Reserve and the forces behind a pretty big force that can move rates has told you that out till probably 2023, they're not going to purposely attempt to help raise rates. Now, can rates go up on their own? Absolutely.
Yeah, because I'm torn on that. Like, there's parts of me where I think the bond market dictates the Federal Reserve's moves sometimes. Like if we're seeing treasuries sell off and rates rise in that market, I'm guessing the Fed is raising rates. You know. So yeah, your point is valid that if we have low rates and they continue to move lower, that's going to be a problem for the banking sector, and maybe the banking sector is already forecasting that heading forward. And so something we always keep an eye on. We're always, comparing bonds versus cash, bonds versus stocks, looking at that mix, seeing how they match up for each model. And we'll continue to do so. So really important developments this week in stocks. We talked about precious metals. We talked about bonds. We talked about the dollar. Anything else you want to cover before we jump to the extended portion of the podcast?
I'd say that overall big picture for clients, 3,300, 3,330, 3,400 are the main areas. Again, NASDAQ above 11,000, still not interested in foreign stocks, not interested in value stocks. It remains, again, if this is the bottom, a short-term bottom, similar to what we saw back in June or July, it again seems that growth, that nothing has changed, which is totally fine with us.
Well, it makes perfect sense.
It does. And we've said multiple times on the podcast that the bear market will end. Most likely the bull market will end when tech begins to underperform. Just as we see market leaders and large market weightings, right? That's really the key here, is the large market weightings have to start underperforming for markets to continue downwards.
Right. Yep. And so we could be, like you said, we could be just watching the beginning of a new accumulation or markup phase. We'll see. That's the beauty of studying price, is we get more information, and sometimes you just need more information. And so next week we get that information. So that's something we always look forward to. I think it's great to wake up on a Monday morning and get more information. And that's what we enjoy doing for our clients. So Ian, I appreciate it. To all those listening, we appreciate it. You guys have a great week ahead, and we'll see you guys next Friday. Otherwise, stay on for the extended portion.
Have a great weekend, everyone.
All right, Ian, jumping into the extended portion of the podcast here. It's just really interesting that we have the S&P 500 sitting at 3298. And we opened the month of August at 3288. So August You had a great month in August for the market, gave all of it back in September. Talk about loss aversion. How many people does September feel twice as painful as August felt good?
Well, I think it does, especially if the longer you wait to get in, the closer in theory you'll be to the eventual top. August was a great month. I think the S&P was up 7%.
Yep.
So, I mean, a great month historically, an above average month.
You know, I think when people look at market performance or maybe account performance and they look at it and they say, oh man, September was so hard, completely forgetting how great August was. And that's loss aversion, right? Like that people have a propensity to view loss as twice as painful as any type of gain.
Oh, I think so. I think it's human nature. I do it. I personally do it.
Right. And so
I'm not saying it's fair or it's right or
right. It's just it's
either.
A human psychology thing that we all do, right? That sometimes it feels like if you got, if you pick up $100 bill, that's pretty awesome, right? Off the ground. Oh, okay. But if all of a sudden you open your wallet and you're like, oh, someone took my $100 bill, it feels worse than the gain.
Oh, for sure.
That's just human nature. And that happens with markets, accounts, you name it. But that is a part of markets, meaning the correction that's taking place in September is not abnormal. It's perfectly normal for markets. That is what markets do.
I still think one of the best shorter term examples of what we could or could not be going through right now is still May 2019. And you wouldn't look back and say that wasn't abnormal, or you wouldn't look back and say that was abnormal.
Right.
Right. I mean, we're coming off, you've also got to put in context. We're coming off of a 55% rally in the S&P.
Mm-hmm. From the lows.
Excuse me, a 64% rally. And in 2019 we're coming off a 26% rally. So I mean, corrections they suck. No one likes it. Especially after feeling like a genius in August.
Well, and how about this? So you said what was the gain off the bottom since March?
64%.
64%. But the S&P 500 is +2 for the year.
64% in 6 months from yesterday.
Yeah, so I mean
10% a month?
Right, and and that's just to get back to even basically.
Yeah.
So I hope that gives people perspective on what's happened this year. And even when we say things like, look at small caps that have gone nowhere for 3 years.
Well, as of yesterday, we were red on the year.
Correct. And, there's plenty of other pieces of information about, and coincidentally enough, maybe not a coincidence, where we kind of bounced today, and something like the Dow Jones is right off the January 2018 high. And so the Dow Jones is only +2% since January 2018.
Better than the global Dow.
Global Dow, right? Great interaction.
Flat for 22 years.
Yeah, great interaction with Technicolor on Twitter. And I brought up the small caps going nowhere for 3 years, and he said, how about the global Dow? So if you look at something like DJT, if you're out there looking at charts, go ahead and pull up the long-term chart of that bad boy and weep, because like you said, 21 years, absolutely nowhere. So pretty fascinating. And that's a part of markets that you just have to deal with. There's ups and downs. The one thing a market's going to do, it's going to fluctuate. That is part of the gig.
Yeah. I mean, look at the 70s.
Yeah. Yes, exactly. I mean, you have periods of time or look at Japanese stocks, or you
look at
and actually, I mean, now that we're talking about it, Japanese stocks held up pretty good.
Yeah, say, on a relative basis, Japan's not horrible. It's certainly held up better than, it's outperformed the S&P by 10% since early September.
Yeah. And so I think that's something to take note of, especially when you look at where we are in a 30-year perspective. This, if we want to call it the, I don't know, 23,000 level, getting above there and holding above there, we could be seeing a tremendous outperformance opportunity out of Japan here.
I'll tell you what's interesting is that, so IFA, if we use MSCI, IFA.
Europe, Far East Asia.
Yeah, world developed, basically developed ex-US. We'll call it that. So 30% Japan, it's only up 6%, or it's only outperformed by 6% off the lows. So Japan, again, clearly the leader there. Again, we'll see. I'm a little bit more intrigued by Chinese equities at the moment.
Yeah, like whether we're talking about
I don't want to hear about
Chinese...
the fraud or whatever you think about what people think about Chinese stocks. I don't need any DMs or emails on that. Price is price. In fact, I think they've held up well, especially the important areas like we mentioned earlier, Chinese discretionary.
Yeah, Chinese consumer discretionary, if you're using an ETF like CHIQ. Yeah, I mean, there are definitely spots within the Chinese equity space that definitely deserve attention and maybe even allocation. Again, not a recommendation, but there are spots internationally that make sense. I'd love to see a period where Japan outperforms, bring back the old 80s. That would be pretty classic. I would have no problem with that. When we kind of talked about the NASDAQ earlier in the podcast about it creating a higher low this week on an intraday basis than the other major U.S. indexes, how about the big boys or the all-stars of the group, the Apple, the Amazon, the Microsofts, the Googles? Are we seeing that same thing from them? I know we like to look at some of the all-stars of the group and see how they're doing.
Yeah, I mean, you've still got Apple's your all-stars, right? And it's funny that these stocks that we kind of bash, like banks and energy, so things like Citigroup, the big mega cap banks, JP Morgan, right? Those were the leaders during 03 to 08.
Yep.
So again, they're continue to be trashed during this cycle. Just as, right? So tech stocks were trashed during and underperformed during 03 to 08 because they had just come off their big cycle.
Right.
But I think Apple still arguably probably the most important stock in the world. Again, bottoms on the 21st, makes a lower low yesterday. I think looks okay.
Right. Yeah. Seeing some of the all-star names like Apple and Microsoft and Amazon make higher lows intra-week here compared to their counterparts. It's a price divergence. We'll see if it carries through. But it's really important for, if you're a new technician out there, to understand that each period in a market, a cyclical bull, has its own leadership group. And, what Ian was talking about, 03 to 08 being financials, there will be a day again when it is financials. And who knows, maybe there's going to be a day again when it's energy. I don't know.
And I want to this is going to lead me to go ahead and finish your thought, but this leads me on to something else that a lot of people get confused about, but go ahead.
Well, I was just saying there's going to be a leadership group. And one of the beauties of technology, right, is it's a label we use. Okay. And there's going to be many times where quote unquote technology stocks are going to be the leader in a cyclical bull. So let's talk 40 years from now, we're another 10-year cyclical bull or something like that. And it's tech stocks. It's just not going to be the same tech stocks. It's going to be a completely new industry, right? Tech is just this nice thing label that we can say for emerging technologies, right? Yeah. Maybe it's autonomy, maybe it's robotics. I know robotics is a thing now, but these are just things to keep in mind as technicians.
Cloud computing, right? Cloud computing wasn't a thing in the last, in the 90s.
Right. And some of these
fintech wasn't, the new age fintech wasn't a thing in the 90s. The things that are included now in, something like FinX, those weren't really around in 1995.
Right. And so there will be cycles, and there will be another protracted bear market. And that's going to be, it's when the now leadership group kind of falls apart, that most likely will take place. That's when that will happen. And then when we come out of that, it's going to be a new leadership group, and it's going to be awesome because
new.
Right, because you're going to be able to see that as the bottoming process develops, the bottoming process that you won't know in the moment, but as it unfolds, you'll see a new leadership group.
The continuation of avoidance behavior, right? So even as you're coming into a new bull market, you're still not willing to buy what led the last bear market down.
Right. So it's just something we want to make technicians aware of out there that might be new, maybe even new to their career. There's different leadership groups for different cycles, or it's a fancy term people say all the time. Oh, this cycle, that's what we're talking about. This current cycle, this current uptrend is being led by
kitchen
growth
cycles.
and tech. Yes, kitchen cycles, yes.
As opposed to bathroom cycles and garage cycles.
Destiny's really. All right, what did you want to pivot to?
So one thing I want to touch on real quick that I continue to see a lot of misinformation on is there's a difference between value stocks and value investing and momentum stocks and growth stocks, or just really growth in general, right? So we have our the S&P sectors are kind of split up between, we'll call them growth, value, defensive, right?
Mm-hmm.
But value stocks, so financials, energy, while yes, those are the value investing stocks of right now, and those two terms happen to overlap, value investing does not necessarily mean you're buying banks and energy. It does right now in the environment we're in, but I mean, 0304 value investing was tech and the things that had just got crushed, right? And the same with momentum. So there's this constant comparison of Momo stocks and growths and the high fly growth stocks and the quote unquote growth sectors. And it's not the same, right? So there, 03 to 08, to go back to this, the momentum stocks were regional banks and small cap oil services.
Right. I mean,
we just happen to be in an environment where the momentum stocks are growth stocks, and there's this recency bias for the two to be hand in hand. And to me, it's just not. Value investing does not mean I'm going out and always buying energy and financials.
Right. Exactly. And this maybe this causes more confusion than anything, but I always like to say I'll buy value when it has momentum.
I think that's a great way to put it.
And so that's one of the things where, yeah, if value is underperforming, fine, but let's buy it when it's not. And let's buy value when it has momentum.
Yeah. And you've got things like, again, energy had a great, I think XLE was up 70% off the lows at one point, but it had underperformed so badly for the previous 5 years that run of alpha off the March lows did nothing to offset the fact that you should absolutely not own it.
Correct. Well, and it's given all that back. I mean,
it's given all that back and more, as we mentioned in the last section. And same with, you look at, I think small cap financials hit new relative lows. I think European financials hit new relative lows this week. It's
dispersion, baby.
It's hard for, again, not to step out of the TA box, but let's take financials for what they are. The market trades banks, right? So this is a domino effect. The market trades banks off of interest rates. Small caps are going to trade off of banks. So it's kind of the A equals B, B equals C theory.
Yep. And so there's knock-on effects. We kind of talked about bond compression earlier. What are we seeing in other areas in the bond complex? We kind of talked about credit spreads a little bit, but
You had touched on credit spreads.
high yield and junk.
Not short term, not great. So if we're gonna take like J and K, probably need to see that back above 104, 105 before super excited. Again, I don't know how much this has to do with the energy sector, right? We know that
Yeah, there's quite a bit of energy
big chunk
stocks
of high yield is energy.
And that's a good point too. But typically we see junk and high yield bonds moving directionally the same as equities and risk on, risk off.
They're about as unimpressive as small caps right now.
Yeah. I mean, you look at something like you said, JNK being below 104. It's notable. I mean, that's below the June high.
It's a check in the wrong column. I'll tell you that if you're bullish, it's a check in the wrong column, and that's just what it is right now.
Yeah, and you got to be aware for it. You got to be aware of it. So good stuff there. As we bump up towards the end of the podcast, anything else you want to kind of touch base on? It could be anything. It could be what you got going on this weekend. It could be just things you're noticing out there that you want to address.
So first and foremost, I'd like to say that going back to breadth, something that we've really been looking to expand on our studies internally at Adaptive has been breadth. And we've shown that with some of our sector and industry work, but again, our intern Pratty continues to do awesome work.
Yep, had a great week. Pratty had a great week.
Super timely work. Great church. And Kevin as well. Kevin's
Kevin's an all-star.
Kevin's God, Kevin, please never leave.
No, that's good. I mean, that's legit. No, he's awesome.
He's so great. I mean, the trading is He always wants. He knows what we're thinking. At this point, Kevin knows what we're going to ask for. So doing a lot of going back to this, Pratty has put together something. He's just helped so much with getting around to things that we've wanted to get to and making a routine out of it. So I'd say breadth when we're looking at things like stocks above and below their moving averages, still a little sketchy out there.
Yeah, I mean,
it's with some divergences. I'm not going to say it's as bad. Now, when you look at, January versus February, some clear divergences out there, some really harsh. The ones recently have been a little more, I don't want to use the word sustainable, but a little more practical, not as dramatic. But there's weakness under the surface. And this goes back to small caps. We have got to see small caps get it together.
Well, even in something like the S&P 500, which has only 26% of the S&P 500 is above its 50-day moving average.
And 50, I mean, this is not, I mean, those are,
and we're talking about 54% of the S&P 500 above its 200-day moving average. So there's been some damage done for sure. Getting into 50% of stocks in the S&P below their 200. You had shared a study internally today. Things start getting a little sketchy there. Yeah, a little cliff edge, a little bit.
Well, and that's hard, right? When the majority, I don't care how you're weighted, but when a majority of how you're weighted from a percentage weight, but a majority of stocks out of 505 below their 50-day.
Yeah. And there's two ways. There's two ways to look at this breadth. Is you have that amount that's below its 50 or barely any above, right? So if we like 50-day, for example, 26% above it. It's also a place where we see bottoms happen. So it's cliff edge, but it's also a place where it's normal for intra-year, 7 to 12% corrections that takes place.
We all won in 2017 with
no vol.
No
just
vol.
an escalator ride.
I don't even think we had a 10% correction that year. I don't even think we dipped below the 100-day.
I don't think we had a 5% correction that year.
I don't think we did. I think you're exactly right on that. I don't think we did either.
But yeah, if you've got 54% of stocks in the S&P 500 above their 200-day, there's some work to be done there. And if we've got a flat 200-day on the index itself, I learned from JC that's a hot mess scenario. There's going to be some messy price action with a flat 200-day moving average. It's just a lesson that he's passed along that I appreciate and acknowledge.
Well, and it makes so much sense. Like, if the last 200 days aren't trending up, like, why try and predict what the next 20 or 50 days are going to do? You have no idea.
Right.
There's nothing there that gives you an edge.
Exactly. If only we had a 200-day moving average for Gamecock football,
it would be in a downtrend.
It'd be a downtrend, but you're still excited.
Still excited. I'm buying the dip. I'm constantly. I'm a bag holder. I'm a big time bag holder
on the Gamecocks.
Yeah, I am. We're foreign. I mean, we'll see.
Isn't that beautiful? Isn't that beautiful that you can take and use an analogy like markets on football and realize who you are?
Yeah, like, and it's true, and I'll admit it.
Yeah. No, it's good.
If you could see, if you could see our, and it truly is. I've got a pretty nice man cave basement set up at home, and my wife has been fortunate for me to kind of allow to do whatever I want with it, and it's full. It's full of signed jerseys and helmets and pretty much anything sports related. I've got an entire wall dedicated to Gamecock football. I'm all in. They could be 0-12 and I'd be there the first game of the year, 7:30, watching them. So we'll see. I actually, my friends and I have a little, always have a group chat going where we talk about Gamecock sports, and honestly, as pessimistic as I can be, I'm predicting a win tomorrow. So we'll see. It's at home.
Wait, you're predicting a win?
I am.
Against Tennessee?
I think, against a ranked Tennessee program. I think 23-20. We're in Soda City.
Woo.
I think, new offensive coordinator.
So if we're below the 200-day moving average, we're getting a reversion to the mean.
I think reversion
Gamecocks
to the
are winning.
mean. Yeah, I'm not saying the season's going to be great, but I think we get off to a good start. I think it's a bottom you can buy. If we get stopped out around week 4, that's fine. We were long with a good risk reward.
Yeah. I got you. That's awesome. Gamecock football. I know you get stoked for it. I know why you've got such a nice man cave, because, you can't be watching Gamecock game in public and share your opinions.
No, I've got a funny story I'll have to share with you at some point. But yeah, we do. My wife and I do not watch South Carolina football in public anymore.
No,
no, we don't.
No, that ain't happening. Speaking of watching football and commenting on it, anything you want to touch base with regarding El Presidente, David Portnoy?
Yeah, and we've touched on this before. We touched on it at the beginning of it. I gotta be honest, if you're a professional in this industry and things like David Portnoy upset you,
and for those of you who don't know, I assume you do if you're listening this far into the podcast, but David Portnoy is a marketing genius.
President of Barstool Sports.
Right, he sold it to Penn Gaming.
Mega million. Yeah, sold a third of it to Penn National. Just an absolute
gregarious guy, like big personality.
Think he's hilarious.
Yeah, he's hilarious. And when sports got shut down, he pivoted to stocks.
For the meantime, it's not like Barstool just stopped talking about sports.
Right. And it's one of those things where,
but he wanted something to do.
And I think it says a lot about markets and managing money, period, that it is the biggest competitive arena on the planet.
Oh, yeah.
And so he pivoted to something else that was competitive, right?
Mm-hmm.
Because really when we're involved with markets, we're involved with the brightest, the smartest, the quickest in the game.
Hundreds of thousands of participants and trillions of dollars being thrown around every day.
Right. And so there's real world ramifications, just like when you get your bell rung playing QB. And so he pivoted to that. And I agree with you. Like, if the guy's going to spout off about stocks, fine. Like,
who cares if he's a dork? Who cares about the ridiculous stuff he says? Like,
right. Yeah. If you don't think he's an entertainer, come on.
I find it really telling when other professionals, right? Because he likes to make fun of the quote unquote suits, which are, not people who wear suits, but professionals registered, licensed in the industry.
Well, I was going to say, I don't wear
you and I. Yeah,
swimsuit. I'll wear a swimsuit.
But he's referring to the licensed professionals.
Yeah.
And if you're letting him get in your head, you already lost, dude. Yeah, dude,
won.
You've already lost. You respect yourself more than to let something like David Portnoy talking about how, I see things when Dave says, oh, bear markets only last 2 weeks and people just go live it. He's like, why are you letting him troll you?
Yeah. Just, why does he got to live rent? At least make him pay rent. Why does it got to be rent free in your head? I
love it.
Yeah, I do too. He knows exactly.
The TikTok investors, all of it, this whole new fad, this retail fad. They're not pushing the market higher. They're absolutely not.
Right.
But I think it's fun to watch a new generation participate in it.
Yeah,
and they'll learn their lesson just like everyone has.
The lesson is coming.
At least they're not. I would say, honestly, here's what I think. I actually think it's a bonus. I think people from my generation, the millennials, got scared out of the market, and we've got a new generation who is creative and forward-thinking, and I think Gen Zers have a lot better attitude towards. The whole idea that retail pushed this market higher the last 6 months is so
bananas.
It's so bananas, and it's so first level thinking that I can't take anyone seriously who believes in it.
Right. And that's why, letting a guy like Portnoy, or like you said, the TikTok videos get you triggered. Yeah. Just enjoy it. It is and observe the social mood. Understand what it is.
Yeah, understand what it is. It also doesn't mean it's the top.
Right.
I guarantee you in 1995, 96, 97, if TikTok was around, kids would have been doing the same thing. Doesn't mean it's the top. We went up another 240%.
Right. And so
have fun with it. I think these kids out there make funny content.
Oh, absolutely. And I was talking to some college kids the other night where I told them, you live in the golden age of investing, man.
Oh my God.
You don't have front end loads.
You get free commissions.
Yeah.
In the next 12 months, you're going to have fractional share. You already got it on the S&P. You're probably going to have it on every single, I would say in the next 24 months, a lot more stocks are going to be able to be purchased on a fractional basis.
And if you want to go buy Chinese,
it's the democratization of investing.
If you want to go buy Nigerian stocks, you can. If you want to go buy Chinese consumer discretionary stocks, you can. I mean, the things that are available now compared to 70s and 80s, it's crazy, and you got no minimums. So it is the golden age of investing.
I'd also like to point out that off the lows, Saudi Arabian stocks have outperformed the S&P by 18%. So, and those are investable. You can buy a bucket of Saudi stocks. I mean, it's your you can do whatever you want. But I'm just I think it's great. I think everything that's happening in the market and the industry right now is awesome. It doesn't bother me. I don't get offended by it. Let kids be kids. They're going to learn their lessons just like everyone else has, but at least they're making funny content while, they're doing it.
Well, yeah. And if a guy scores a touchdown, celebrate. You know what I mean?
Yeah. Why are you getting mad at the 17-year-old kid who just made $1,500?
Yeah. It's it just understand that it's like watching a game and watching someone new that's playing football. They're going to get licked. They're going to get blitzed. The bad plays are going to happen. And you don't have to sit there and hope for the bad plays just because there's a new kid on the block or whatever. I don't want to see anybody get hurt. That's not my point. I don't want to see someone lose their livelihood or do something stupid where they're taking out a mortgage they shouldn't be taking out and just piling in because they have a guess. That's not what we're saying. We're not saying fast and loose. We're just saying people are going to have to learn. And I'd rather have them learn with a $1,000 account than a $500,000 account.
And I'll tell you something else. This generation of kids who are interested in this, and I know that like the dorks who want to make their TikTok videos or whatever, they're buying Nikola, they're buying Tesla call options, they're buying Apple Virgin Galactic,
as long as they're avoiding the crash wall.
There's also a lot of kids out there like Pratty who have become interested in stocks and taken a little bit of different approach. Yeah. And I feel like that's the type, like that has, I'm thankful for this generation being so interested because it's brought people like Pratty to us.
Yeah, right. No, exactly. And there's lessons to be learned all around. And I give a lot of credit to a guy like Pratty for recognizing the visualization of supply and demand on a chart to be extremely valuable in a process at such a young age. That's a lesson I wish I had learned in my 20s, and I didn't. That's not something I learned until later. And I give people like that a lot of credit. I'm not sitting here saying you should go watch TikTok for investment advice, or that if a kid doesn't know what an ETF is, or they call an ETF a stock, or they're talking about something leveraged, that you need to be part of that. That's not what we're talking about. We're just talking about recognizing there's a generation getting involved, and that's okay. And it's a good thing. And lessons will be learned with $100, $1,000 accounts that the pain needs to happen. That is part of growing up.
A 17-year-old hates losing $100.
Yes.
And if he loses $100 and can't go to the movies or go to the football game with his friends, he'll learn that lesson.
Yeah, and I'd rather have it. It's kind of like when you're raising kids, right? I'd rather have my kid crash on the bike and learn respect for being in motion than having it happen when he's in his car for the first time. And so it's the same thing. If these guys are getting involved and they've got a $1,000 account and they're losing money on that and it's painful for them, great. Because I'd rather have that than when they have $500,000 $1 million.
And it's the ups and downs of making money, losing money, making money, losing money. Okay. Making the decision of if I want to stop the back and forth, how do I get right? It's the exact same process that every professional out there has gone through. And yet so many people want to mock these kids for, maybe we think they're goobers for their little TikTok. It's just the way this generation does things.
Right.
I personally love it. Again, I'll get off my soapbox. But if you are a professional and you are a big boy who wears big boy pants, things like this should not bother you.
Yeah. Yeah, exactly. So embrace it, understand the social mood of the situation. We've run up against our time. We've had some characteristics this week, swinging back to equities that look like accumulation. We'll see if we get follow through next week. Ian, I appreciate your time. Great work this week, along with the rest of the team. I really appreciate it. For those that listen, we love it. We continue to hit new highs in listenership, and we appreciate it. Until next Friday, you guys have a great week.
Have a great weekend, everyone.